Hi there. In this video, I'm going to be looking at the role of financial management and more specifically, the objectives of financial management. Okay, now, very quickly, there are 5 objectives of financial management in total, and I suggest the best way to remember them is to come up with some sort of memory device where you substitute the letters for different words, much like if you were to learn to play guitar. Every good boy deserves apples every day. To remember the names of the strings, it could help. However, here they are. There's so the very first objective of financial management is to achieve profitability. Okay, so basically, the ability for the business to maximize its profits. Okay, now the way to maximize profits is to reduce costs. Okay, by reducing costs, and even if the price you charge customers stays the same, if you reduce costs, that increases profit. The only other way you can increase profit is by keeping costs where they are and increasing the price, or by increasing price and reducing costs. Okay, that gives you the biggest difference, and that increases your profitability. Okay. However, not all 3 of those scenarios will work. Okay. There's a lot of different factors in play in terms of what customers want and what they're willing to pay, or what the market will bear for that particular good or service. So the business does need to look at it really carefully how they're going to try and achieve their profitability. Another financial objective is growth. Okay, increase the size of the business in the longer term. Okay, so and there are again a lot of ways that the business can do that. Okay, it could be an internal growth, so hiring more staff, or it could be an external growth, merging or acquiring another business or opening other stores as well. We also have efficiency as a financial objective, and that's basically the ability for the business to use its resources effectively and efficiently to ensure that there is both profitability. Okay, so being able to use the resources in an efficient and an effective way that it might help reduce costs to then lead to the profitability, but also ensure financial stability. So, how efficient are they in meeting their financial obligations so they can remain financially stable? Now, in the next 2 objectives of financial management deal with meeting the financial commitments. So the first one is the liquidity of a business. So, this is the ability of a business to meet its short-term financial commitments, which is within 12 months. Okay, so these are the short-term debts. Okay, now, how basically liquid are they in order to meet their financial commitments? Now, this is dealing with really their current assets and their current liabilities. Do they have enough current assets to cover their current liabilities? Now, a bit further on in the finance course, you will actually look at in the processes, you will actually look at the idea of liquidity and something called financial ratios. I will touch on financial ratios very briefly in this video as well. However, you're looking at here in do they have current assets to basically offset their current liabilities, or to meet their current liabilities. Now, again, short term, current assets, current liabilities within 12 months. Okay. Just like liquidity, within 12 months. And finally, we have solvency as an objective of financial management. Now, this is the ability of a business to meet its long-term financial commitments. Now, long-term, over 12 months. And what this looks at is really the debt to equity. So, how much debt, external finance, is there compared to basically the equity, the internal finance? Okay, so do they have enough equity in order to repay their debt, their long-term debt? Okay, now, as I mentioned, there are some ways you can calculate these things in terms of ratios. You will look at these in a bit more detail later on. However, Profitability for a business can be measured with 3 different ratios: the gross profit ratio, the net profit ratio, and the return on equity ratio. The efficiency of a business can be calculated through the expense ratio and the accounts receivable turnover ratio. The liquidity of a business can be measured using the current ratio. It could also be referred to as the working capital ratio. And solvency can be calculated by using a debt to equity ratio. Now, solvency can also be referred to as leverage or also gearing. Okay. However, they all essentially mean the same thing. Okay. So the level of debt to the amount of equity that is in the business. Now, the next video in this finance series looks at the interdependence of the key business functions. However, I hope this video on the objectives of financial management has been informative and valuable. Thank you.